Welcome back. We apologize for not being able to bring you that market update. They're battling with some gremlins in our lines. But for now, the Reserve Bank governor and his team have revised South Africa's 2023 growth forecast to 0.6%, down from 0.8%, keeping this year's prediction at 1.2%. Meanwhile, the Bank of America projects a 1.5% growth in 2024. That's as it expects load shedding to ease and consumers to experience relief when central banks start cutting rates. Last night, Zinati spoke to Tatonga Rusike. He's sub-Saharan African economist at the Bank of America Global Research, discussing economic growth predictions and the possibility of a recession. Here's that conversation.
No technical recession. I think, as you mentioned, that 2023, we started with some upside surprises, which was good because we had actually finished 2024 with a fourth quarter recession. And we're worried about a technical recession, but it never materialized. Now we had a contraction in the third quarter now, but it was really shallow, and we think that fourth quarter is likely going to be positive, but perhaps less than what the central bank is estimating. So for the full year, we're estimating about 0.5%. We think that also that the consumer is really weak. We saw contraction of consumption in both second and third quarters. So going into this year now, we think that there is some upside to growth. There was quite a lot of investment last year, particularly into renewables. And then Eskom also had power plants that were out that are now back on stream, particularly from Kusile. So it is a better outlook that traditionally South Africa should grow around 1.5% as a starting point. If there are drags, then you can come down. But if there are more positive shocks, then it can be higher than there. So our starting point is really 1.5, but relatively speaking, 1.2, 1.5, it's neither here nor there. It's still very weak growth for a country that also grows population-wise around 1.5. So if we want stronger numbers, then we need to be seeing 2 to 3%, and we are still not yet there.
Well, I'm actually wondering, because you're talking about, some sort of relief that we could get in terms of local structural issues that we have struggled with for a long time, but also even globally with inflation now showing a trend of coming down. And I'm wondering, you talk about, of course, still weak growth, but could these things maybe provide a sufficient springboard for sustainable momentum going forward?
So, the good news from the global environment is that most central banks are starting to turn dovish. And we could see the US, the Fed, cutting rates as early as March. So that helps on the transmission to South Africa, that you could have the currency also appreciating. We have a forecast of 18 for year end for the rand. So much of that appreciation could come in the second half. So that transmission is also positive for inflation. And so we see domestic inflation also moderating. But we do think that the SAB is not going to rush into a cutting cycle. I think first half has got some setbacks. You've got an election coming up in May. The rand could be volatile depending with various election outcomes. So they're going perhaps to start in July relative to, let's say, markets are pricing an early start for May. And if today is something to go by, then don't hold your horse for early rate cuts as far as South Africa is concerned. So we do think that they'll start from July, and then you will have about 75 bips or so to year end in terms of cuts. So that's something positive that's coming from globally. But domestic, we are looking more at setbacks rather than positives.
Well, just talking about the SAB, we do know that the MPC members were for today's decision, but Lesetja Kganyago did announce the appointment of David Focus, as he was, of course, an advisor of the SAB, but now he is a member of the MPC. Do you expect any kind of significant impact on the direction of monetary policy there or not?
Not a change in the direction of monetary policy. I think SAB is a solid organization. Usually when somebody is appointed as an advisor to the governors, it's usually a stepping stone to be a voting member of the MPC. But what the governor also said is that when, rather than if, the president appoints another deputy governor to replace DG Naidu, I think you probably see the SAB members coming to 6. So that means we could eventually be seeing 7 members in the MPC. So it will have more members, which will strengthen decision making. But we are now coming at a time where we are pivoting towards cutting. So monetary policy is now becoming less exciting. So it is a good time to absorb all the transitions with new members. The governor himself himself has got his term of office that that is supposed to expire in November, right? So he's open to staying, but the determination is yet to be done by the president. So we could have some transitions, but they come at a time when monetary policy is now less exciting. If it was time around hiking, you would worry quite a bit. But I think the pivot now is probably good to consolidate. So it is good, I think. The SARB as an institution is very strong.
And that was Tatonga Rusike. He's Sub-Saharan African economist at BOFA Global Research. Now, yesterday's MPC decision to keep the repo rate unchanged at 8.25% was a unanimous one, marking the fourth consecutive month of standing pat on interest rates as inflation remains sticky. Experts, in the meantime, largely believe that the interest rate cuts should start taking place in the second half of the year, but it is likely to be quite shallow. Annabel Bishop, who's chief economist at Investec, joins us with her outlook for potential interest rate cuts moving forward. Annabel, always a pleasure and a good afternoon to you.
Thank you so much.
I think before we get into the issue of cuts, Annabel, maybe we can reflect on yesterday's address by the governor. It's still rather hawkish, if I just think back on it. I'm keen to get your overall thoughts on that address.
Absolutely. It's still hawkish. And in fact, the United States is still hawkish. And overall, monetary policy authorities are being urged by large multinationals, for example, such as the IMF, the World Bank, etc. But in general, to, stay the course on inflation, to not be too quick on cutting interest rates. And of course, that's really the message that the Reserve Bank conveyed yesterday as well, the MPC, saying that they wish to see inflation at 4.5% and to be able to believe that it will sustainably remain around that point, because that is obviously what they are targeting from an inflation perspective. The Monetary Policy Committee, obviously, its primary objective is to keep inflation at 4.5%. And as a consequence of that, it's unsurprising that we didn't have a cut yesterday. And of course, unlikely we'll have one in March either. In fact, for the year ahead, we only expect inflation will actually drop to 4.5%, round about the midpoint of the year. And the Reserve Bank's actually got a worse forecast than we have. We have an average for 4.5% for the year. They have an average for 5% for the year. So you can see from their statement they're not considering any interest rate cut. There was a unanimous vote on no cut, and it's something they're going to be watching, looking ahead.
That 4.5%, halfway through the year that you're forecasting, Annabel, I want to use an economic term. Is it ceteris paribus here? All things remaining equal here. We're not expecting, things in the Middle East to escalate. We're expecting the rand to hold up around the 18 to 19 rand mark, and really for there to be no more shocks to the global or local economic systems.
Absolutely. And the Reserve Bank themselves noted how quiet we entered 2024 for a change from a January perspective, and that's why they didn't revise their forecasts materially. But of course, what really counts as well is that we have seen the escalation in costs from a freight perspective globally in supply chains because of the deterioration in the conflict in the Middle East. We obviously have seen the Suez Canal become unusable for many shipping routes. And of course, the problem really is that it's much more expensive to go around the Cape of Good Hope. And, looking at the conflict there, doesn't seem likely to resolve anytime soon. The governor also noted as well that in Panama, obviously, there's climate change that's having a drought effect on the water level. So again, these contribute to higher costs. And of course, that could be something that does have some impact looking forwards. On the plus side, the El Nino effect, which was feared to push up the food price inflation rate, which is the largest component on its own of CPI inflation, is something that is unlikely now to materialize to such a large degree. So overall, the Reserve Bank does feel quite comfortable with its inflation outlook, with the outlook where we are. But as you quite rightly said, much can depend on other factors. Perhaps what does the United States do in terms of its interest rates? And there, we're looking obviously for the first cut to come in the May-June period. That's certainly what the financial markets are signaling as well. It's unlikely they'll cut earlier than that. But of course, this afternoon we have the PCE core deflator figure out, which is obviously what the United States monetary policy do focus on in terms of trying to achieve the implicit inflation target, which is actually at 2%. So all of these factors really center around South Africa having many global and domestic factors that have an impact, but certainly we continue to believe that inflation is on a downward trend. That means that overall inflation tends to come out lower than it was a few months ago. And of course, there can be 1 or 2 months where sometimes you get a jump up, but then it does tend to come down again. At 5.2%, we're below the peak of 7.8 and still likely on track for 4.5% around the middle of this year.
I must ask you, Annabel, also just looking at the risk that we're all trying to contend with here. And I think the markets also definitely jumped the gun in terms of cutting. I guess they're really happy to hear some dovish commentary coming out of the US Fed at the end of 2023. And obviously now, I think we've priced in reality, which is absolutely fine. But when we think of a global risk here, how are we adequately pricing in, what we are seeing here? All these elections, Annabel, I think we've spoken about it before, I think, but the issue of elections, I think, for me is also a big concern. And if that can have a direct impact on inflation globally and here at home.
Yes, you're quite right. There are elections around the world. People are watching to see what happens in terms of Donald Trump. And of course, inflation is the key consideration, first and foremost, for all central reserve banks. And, we're talking about that core PCE deflator. It came out above 3% in the last print. Today it's expected at 3%, still very far removed from the 2% mark. So typically, central banks do not allow politics to interfere in their monetary policy setting conditions. And of course, that means that they're unlikely to rush into interest rate cuts to try and make, current incumbents look good. So, while we obviously have the South African election this year, potentially any time in the second to third quarter, the concern obviously there is what will the result be in terms of government thereafter. Will government come out more left-leaning? Will it come out similar to what it has? Do we have continuity of economic policy, of Reserve Bank policy, of all the things we've come to rely on, or do we see changes? And of course, the polling results, while too early to tell for sure, do indicate the ANC will likely remain the largest political party in South Africa. They indicate as well that, the ANC could go into a coalition with other political parties. Some polls show only small loss in ANC majority, which means it could go into coalition with some tiny parties. Other polls show a bigger loss, and of course, there are many options open. But overall, the general consensus is that the ANC is unlikely to see major change, or South Africa is unlikely to see major change after the elections, which leads to a deterioration in the business environment, in the monetary policy environment, in the economic policy environment as well. So that's comforting. And of course, from that perspective, we don't expect the Reserve Bank to react to the elections. We don't expect them to react before the elections as we get very close to them or afterwards. We think that they will remain very focused on inflation. The Monetary Policy Committee in South Africa and the United States have actually always portrayed that attitude. In the US, looking forwards, much will depend instead on the economic data that comes through. We've had some good data recently, a strong US GDP figure of 3.3% versus the 2% expected. And of course, as well, we've also had a lift up in the manufacturing PMI, which shows now some stabilization and growth in the manufacturing sector and not a contraction. So all of these factors do point to potentially a soft landing for the US. It may shift some of the market expectations out in terms of the timing for the first interest rate cut in the US, which it has obviously done so. But nevertheless, this has all been mild and modest news. Nothing which has actually caused any type of financial market stress or intense, stress, such as distress. So really, where we find ourselves going forward for South Africa, we continue to expect the first interest rate cut will be in July this year. But obviously, much depends on when the United States decides to deliver its first cut.
I'll also ask you, when we start cutting, Annabel, if I think back to March of 2020, the repo rate, I think, was 6.25%, if I'm not mistaken. And then, of course, we peeled that back because of COVID-19, and then we built it all back up again because of inflation. When we start cutting, can we expect to cut back to that 6.25%, which I assume is the normalization we're all kind of hoping for?
Yes, thank you for that question. So look, really what the Reserve Bank says is that they look at the neutral real interest rate, which is 2 to 2.5%. Above the inflation rate. And if the inflation rate is 4.5%, which is what they want to achieve before they cut interest rates, what they need to achieve, that really tells you about 6.5% would be your neutral real interest rate, possibly 7. So from that perspective, we think we could get a 125 basis point cut, 1.25% interest rate cut overall in the current interest rate cycle. We do find ourselves in a situation, however, where it's probably going to be pushed back into into the second half of this year and then over the course of next year. Members on the MPC committee, not only the governor himself, have stressed that they really need to sustainably get back towards targets. So it's very normal for markets to have exuberance, to start to factor in interest rate cuts before they happen. It's positive for equities when interest rate cuts happen. Obviously, they do tend to strengthen. It's positive all round, for sentiment. So from that perspective, that's what people hope for. That's what market players hope for. But we are seeing cautious central banks around the world and here in South Africa.
I must also ask you, in the US, we saw a few shocks, people reacting to the shock of expensive money. They were used to really cheap money. We saw some other, the banks, the regional banks are going under as a result and all of it. Wondering if the US will also ever see cheap money like that again, Annabel. Is it possible that we might see that? I think they had negative, almost zero interest rates there before all of this inflation.
Yes, thank you so much. Look, of course, that's crisis level cheap money. And of course, we'll be going to a crisis, a financial crisis, a COVID crisis, any type of financial market crisis. We do see central banks paring down interest rates back to the minimum. And really what we mean by that is advanced economies can cut back to zero. For an emerging market, we still need to have a differential between us and the advanced economies interest rate. So for us, we maintain that 3.5% differential. I hope we don't go into another financial market crisis soon. We've obviously still recovering from the last impact, but of course as well. Nevertheless, this is still obviously a risk, and it is one of the tools in the arsenal of central banks globally. When it looks like economies are going to crash, when they go into recession, that is what they do to help. That is how they deliver relief to consumers. And obviously for those who are indebted, they appreciate it enormously.
In his address yesterday, the governor said that average salaries grew less than expected in the latter half of 2023. That tells me that we don't have a sticky wage price inflation. But just mentioning the issue of elections again, populist policies, giving people a little bit of more money. This is stuff that can happen specifically with the public sector wage bill. And I'm wondering if that expectation could be a driver here at home, something that we should be talking about now, trying to price in, what happens with that huge public sector wage bill. Of course, will affect fiscal policy, but even from a monetary policy and expectation.
So that's a very important point. It talks to the supply of money, it talks to expenditure in the economy. And in fact, obviously, as we know, we've come through a high interest rate cycle. It's been, a hard interest rate cycle after COVID, and it really has capped demand. We don't have demand-led inflation in South Africa. It really does come from the supply side. There's no need to hike interest rates further. And of course, a need to cut interest rates once inflation comes under control. South Africans do indicate that high and rising prices, high inflation is very problematic for them, and that's the Reserve Bank seeks to deter. So from that perspective, we do expect the Reserve Bank to continue on that trajectory. If we obviously have a look at fiscal policy in South Africa, fiscal policy has unfortunately seen a lot of slippage. We've seen a growth in expenditure, and we've seen revenue undershoot. That means that our plans to collect revenue have not been met. The revenue collections have been negatively affected by the low commodity prices over the past year, and of course as well weakness in the global economy. But let's not forget the problems we've had at home in terms of Transnet not being able to get the bulk commodity goods through the railway lines and through the ports, and obviously earn the forex that we need to not only stabilize the rand and bring it stronger, which of course then helps against imported prices such as oil prices and brings inflation down. We wouldn't have had to have such high interest rates. But also of course as well, we found ourselves in a situation where Eskom has obviously seen the highest level of load shedding last year than ever recorded, which also negatively impacted our exports and of course as well the economy, and in turn damaged government finances. So these fiscal policy issues, we carry on into this year. We have increased our planned borrowing to meet this. Government is not expected to increase taxes in a already subdued and weak economy. And of course, as well on the election year, we also have the situation where revenue is not expected to see a boom this year and cover ourselves with that. So unfortunately, we have seen a blowing out of our borrowings, which has negatively impacted our longer term borrowing costs, the debt market, and of course our country risk. Now, when we do obviously have a look look at the government wages, they obviously have seen marked increase, and it's a rapid growing item. But again, it is something which government seeks to try and keep around inflation, but obviously very difficult with unionized pressure. We don't think government is going to cave in and give a special big increases this year in an election year. We think they will continue to stick to their guns, but you're very correct in signaling that it is a weakness in the South African economy, and it is, of course, because it's current expenditure and has impact on monetary policy as well.
Well, Annabel, that's all we have time for today. Looking forward to unpacking more of this, especially as we head into that budget later on this year. Well, now, soon. Thank you for your time today. That was Annabel Bishop. She's Chief Economist at Investec.